Hello friends, welcome to my channel. My name is CA Pravesh, and in this video I am going to discuss about return on assets, which is very important financial metric, a very important profitability ratio. Return on assets is used in measuring the company's ability to generate profit on its total assets. It is a measure of efficiency of the company in earning the profit on the economic resources or the assets it has in its balance sheet. So, by using this simple formula, we can calculate the return on assets. It has two components. One is net income and another is total assets of the company. Return on asset is best when compared with the similar companies. And asset intensive companies like manufacturing companies will have huge capital asset as compared to the companies in another industries like the companies which are making softwares or companies which are working in accounting consultancy. So it is better to compare the return on assets of peer companies rather than the companies of different industry or sector. Now let's understand the calculation part of return on assets. Return on assets can be simply calculated by using this formula. However, analysts have used several variations of this formula, but yet this formula is considered best and most practical formula. As you can see that the income or return part of this formula include not only the net income but also the interest net of tax. This is because the another component, that is asset, means total asset, and the total asset of the business is financed not only by the money of the owners but also by the money invested by the lenders or debt providers of the company. So when we call return on assets, that means return on total assets. Now friends, to get more understanding about it, let's do some mathematical calculation. As we can see on the screen, I have given you the income statement of a company XYZ Limited, and in this income statement we can see that the sales is 100 million and the variable cost is 50 million, and after deducting variable cost we get contribution margin of 50 million, and out of this 50 million we have to deduct the operational fixed cost which include rent or salary etc., and that would be 10 million. After deducting operating fixed cost, we will get the operating profit of the organization, which is also known as earning before interest and tax. As you can see that I have deducted the interest expense of 5 million, and after deducting the interest expense we've got the profit before tax of 35 million. I'm considering income tax to be 20% of profit before tax, and that would be 7 million, and after deducting the income tax we would get profit after tax of 28 million. I'm considering that there are some preference share capital and the commitment of the company is to pay 8 million as dividend. So after deducting the dividend we'll get earning available for the equity shareholder. This is also known as profitability statement. Now let's consider the average total asset of the company including fixed asset and current assets are 160 million. Now we have to calculate the return on assets of this company for this year, particular year, to which this income statement belong. So in order to calculate the return on assets we'd use this formula, and this formula is net income plus interest net of tax divided by the average total asset of the company into 100. Now let's do this. What is the net income? This part is called net income, and net income of the company is 28 million, and interest is 5 million, and we have to deduct 20% out of it and divide it by the total asset 160 million, and to express it in percentage we multiply it by 100. So this would be 28 million plus 4 million divided by 160 million into 100, and this is, my friend, 32 million divided by 160 million into 100. which would come 20%. So this is how you calculate the return on assets. So whenever you are given total assets value and net income as well as the interest expenses including tax rates, you can easily calculate return on assets. However, you shall calculate the return on assets of multiple companies and compare each company's return on assets to find out which one is performing well on its assets. So far we have understood the meaning of ROA and the calculation part of it. Now friends, we shall understand how we can increase the return on assets. So there are two aspects of it. One is increasing the net income and another is reducing the utilized assets. So how to increase the net income? Let's understand that part. There are multiple ways to increase the net income. One is increasing the sales. Now how we can increase the sales? There are two possibilities. One, either by increasing the pricing of the product. Two, if you cannot increase the price of the product, you can work on increasing the number of transactions or number of sales transactions. Similarly, we can also increase the net profit by reducing the cost of the product, making it more efficient and effective. We can also increase the net income by keeping our assets busy, by increasing the productivity of the assets. Similarly, we can also increase the return on assets by reducing the employed assets of the organization. This can be achieved by working on various factors. For example, we can work on reducing the conversion period of raw material into finished goods. We can work on reducing the debtors into the cash. We can also work on eliminating or divesting the assets which are idle or not efficiently used. Another way to do so is leasing the assets instead of buying them. That means the company can take an assets on lease or rent rather than buying them and keeping them on the balance sheet. And the last but not least, company should always focus on efficient utilization of its asset. The optimum utilization of asset would eventually lead to the reduced cost and increased productivity. So this is all about return on assets. You can use this ratio in order to evaluate the efficiency of the company, in order to evaluate the performance of the company. However, along with return on assets, you shall also consider other metrics, other ratios, other parameters in order to judge a company's performance and invest in such companies. Thank you guys. Keep learning, keep watching, and don't forget to subscribe our channel. Thank you.